Let's now look at part B of the question 2 of the pilot paper 2026, right? So part B is to advise management of Mega on the accounting for deferred tax assets and the deferred tax liability balances as at 31st March 2025 arising from the property, plant and equipment related balances mentioned above together with the required calculations. So the question is from LKS 12, income taxes. So income tax include two things, current tax and the deferred tax. So this question is from deferred tax area. How to recognize the deferred tax assets and the liabilities in terms of this particular scenario, especially with regard to the property, plant and equipment items. Okay, right. So we know the requirement. Now let's start reading the question. Yeah. Mega's property, plant and equipment and investment property information as at 31st March 2025 was as follows. So the year end is 31st March 2025 in this situation. You have been given the PP&E and the investment property information. So there are number of asset categories: land, building, machinery, motor vehicles, other equipment and capital work in progress. So you have been given the cost figures of each item. Then thereafter the accumulated depreciation. So you can get the cost minus accumulated depreciation, your carrying value, right? That is the net book value in our financial statement. What is the asset value? Cost minus the accumulated depreciation. Then you have been given the capital allowances claimed up to 31st March 2025. So for the tax purpose, you have claimed, for example, let's say building. If I take one example, if you look at building, cost is 1 million. Accounting depreciation accumulated value is 247.5 million. But for tax purpose, you have claimed altogether how much? 400 million. So if you want to calculate the carrying value, I told you cost minus the accumulated depreciation. That is in our financial statement, what is the asset value? If you want to calculate the tax base, what do you do is cost minus capital allowances claimed, right? That is the tax base. In tax purpose, what is the value of these assets, right? So the tax base is the amount that you can claim in the future tax returns, right? So that is calculated cost minus the amount of capital allowances claimed up to date, right? Then then you have been given the cost of each item. Then thereafter, with regard to land, there is no accumulated depreciation because land is not getting depreciated, right? Because it has actually unlimited useful life, so that it's not getting depreciated, as well as you are not given capital allowances on the land. Then if you look at motor vehicles, so the cost is 900 million. You have accumulated depreciation 89.1 million, but it's mentioned that capital allowances cannot be claimed. So if you know the tax law, if you use motor vehicles, right? So the certain motor vehicles which are used for the administrative purpose, you are not given any capital allowances, right? So there's a depreciation in the books, but for tax purpose, you can't claim the capital allowances of those motor vehicles. So that's why there's a depreciation, but there are no capital allowances. Then work in progress. So you have claimed the capital allowances, entire amount 750 million, but as it is work in progress, accounting depreciation is yet, it is zero. You have not claimed anything for the depreciation, but capital allowances have been claimed. We'll look at what it is once we go through. Right, then moving up, additional information. The company changed its accounting policy for land, building and motor vehicles from the cost model to the revaluation model effective 31st March 2025. So company has changed the accounting policy with regard to what? Land, building and motor vehicles from cost model to the revaluation model under LK 16 property, plant and equipment. So the subsequent measurement of a PP&E item is, it can be at cost or it can be a revaluation model. So what the company has done was, so they were following the cost model. Now for these three classes, land, building and motor vehicles only, right? So they changed their subsequent measurement model from cost model to the revaluation model. And that will be effective from this financial year end, 31st March 2025. Right? So the other classes, other than these three, still keep it at cost, and there are no changes in terms of those other classes which are not mentioned over here. Then with increase of 10% for the land, okay, with the revaluation, there's a 10% increase in terms of the land, 5% increase for the building, and 4% increase for the motor vehicle based on the carrying value mentioned above. So I told you, you can get the carrying value. How do you get the carrying value? Cost minus accumulated depreciation, you can get the carrying value. So what has happened was, when you apply the revaluation model as at 31st March 2025, carrying value of the land has gone up by 10%, carrying value of the building has gone up by 5%, and carrying value of the motor vehicles have gone up by 4%. Okay, right. So those are revaluation gains. Okay, those are revaluation gains. So what will happen is, the revaluation will increase the carrying value of the assets, but there is no change in the tax base, because the deferred tax concept is depending on the temporary differences. So what is a temporary difference? The difference between the carrying value and the tax base of an asset or a liability. In this case, assets. PP&E items are assets. So once you have a difference between carrying value and the tax base, we call that as a temporary difference. So on that temporary difference, you recognize the deferred taxes. So that temporary difference can be a taxable temporary difference, which will lead to deferred tax liabilities, or it can be a deductible temporary difference, which will lead to deferred tax assets. Okay. So if you look at an asset, if the carrying value of the asset is higher than the tax base, that's a taxable temporary difference leading to deferred tax liabilities, which means you have to pay more taxes in the future. Having deferred tax liabilities means you have to pay more taxes in the future. On the other hand, if a carrying value of an asset is less than the tax base, there is a deductible temporary difference leading to deferred tax assets. So when you have deductible temporary differences, it creates deferred tax assets, which means your future tax liability will be reduced, right? So that is the concept. Again, I don't have time to discuss the full theory, the logic, and the computations and all that, because here we'll do a small computation. All these things we have discussed in our theory classes. If you can't remember, you need to watch the relevant videos and read the tudes. Right. So what will happen is, when you do a revaluation, your carrying value of these three asset classes would increase. You have been given the percentages as well. But the tax base won't change, because taxman doesn't identify revaluation gains. Inland revenue doesn't worry about the revaluation gain. For them, always, what is the tax base? Cost minus the capital allowances. They can't understand the revaluation gains and the losses, impairment losses. So that is not in the tax terminology. So all these things are in the accounting. But what would happen is, once you do the revaluations, your carrying value changes, no change in the tax base. So which means what? It leads to a temporary difference leading to deferred tax implications. That's what you need to understand. Right. Then based on the physical verification, machinery item with carrying amount of 20 million. There's a machinery which has a what? Carrying value of 20 million were impaired as at 31st March 2025. Okay, here you have done a physical verification of the assets at the year end. So where you identified that a machinery item which has a carrying value of 20 million is impaired. So once you identify there's an impairment, what are you going to do? You recognize the impairment loss. So how to recognize the impairment loss? You charge that to the P&L and credit the particular asset. Machinery credit, P&L debit. So once you book the impairment loss, what will happen to the carrying value of the machinery? It will come down. Tax base won't change. I told you, taxman doesn't worry about the revaluation, impairment. right? So the tax base won't change, carrying value come down. So that creates what? Again, a temporary difference leading to deferred tax implications. However, the remaining capital allowances are expected to be claimed for these assets. So you are going to claim the capital allowances on these assets. Even though there's an impairment, that is an accounting entry. You are going to continue to claim the capital allowances for this asset. The impairment adjustment has not been reflected in the figures above. So the impairment adjustment, what you have discussed here, is not incorporated into the figures. That means we have to incorporate that into the figures. Even these revaluation gains are not incorporated into the numbers given. We have to incorporate those, right? So that is what you do in this question. Then capital work in progress was allowed for tax computations in the respective years in which costs were incurred. Here, okay, I explain this. So capital work in progress, what is the cost? 750 million. You have not claimed anything as depreciation, because to claim the depreciation, asset should be ready for the intended use. Still, these items are not ready for the intended use, so that no depreciation is recorded in the financial statements. So if you look at the carrying value of the work in progress, what is the carrying value? 750 million minus 0, carrying value is 750 million. But as per the question, for tax purpose, these capital work in progress items have been already claimed once they incur. At the time of incurring the cost, it has been claimed for the tax purpose. So which means entire 750 million is claimed for the tax purpose as capital allowances. So what is the tax base of this capital work in progress items? 750 million minus 750 million, tax base is what? 0. Right? Tax base is 0. Are we clear? Okay, right. For counting, nothing has been claimed as depreciation, but for tax purpose, everything has been claimed when they incur the particular expenditure. That's what is mentioned. Capital work in progress was allowed for tax computation in the respective years in which the costs were incurred. Okay. Assume that applicable tax rates were, there are two tax rates given, 30% on profits generated from the ordinary business activities. Now, for you to calculate the deferred tax assets and the liability on the temporary difference, we need to have the tax rate, because how do you calculate the deferred tax liability value? Taxable temporary difference into the tax rate. How do you calculate the deferred tax asset value? Deductible temporary difference into the tax rate. Now, normally you are given only one tax rate, but here you have been given two tax rates, because why? The rate is different on the activity. So the tax rate is what? 30% on the profits generated from the ordinary business activities. On the other hand, tax rate is 10% on profits generated from sale of any property. If you are selling any property, on that, if you derive a tax profit, you have to pay on that profit how much? 10% only, right? But on your business operations, you have to pay 30% taxes. Okay, this is something similar to, you have two tax rates. Example, right? As an example, I am telling that for the ordinary business activities, 30%. If you sell some assets and get a gain out of that particular asset disposal, you are getting a tax rate of 10%. Now, why this is important is because in this particular list, you have been given number of items, right? You have been given number of items. Now, what we believe is, if a particular item is a depreciable asset. Now, what are the depreciable assets here? Building, machinery, right? Even motor vehicles, other equipment. So, even capital work in progress is depreciable in future. Still not getting depreciated currently, but depreciable assets. If you look at the last 5 items other than the land, depreciable asset. So the normal presumption is, if it is a depreciable asset, you recover the value of this asset through the use, through ordinary course of business activities. Right? Because the deferred tax, the concept of deferred tax is depending on how to recover the value. Right? So if it is a depreciable asset, you believe that you recover the value of the asset through the use of business. That means through the ordinary course of business activities. If so, any deferred computation of these items, any deferred tax computation of these items, you need to use what percentage? 30%, because these are depreciable assets. Right? Then in terms of the land is not getting depreciated. Then you believe that you are going to recover the value of the land through the sale. As it is not depreciable, right? So you believe that you are going to recover the value of the land through a sales transaction. So if it is a sale transaction, what is the tax rate applicable? 10%. So in simple language, why this particular information was given is, right, this particular information was given is, when you are computing the deferred tax liabilities and the deferred tax asset on the temporary difference, which tax rate that you need to select. 30% for the depreciable asset, 10% for the assets which are not getting depreciated. Okay, right. Clear. All these things have been now discussed. Now we need to move to the answer. Right. Let's look at the answer. Right. Let's look at the answer. Before moving to the numbers, right, before moving to the numbers, let me explain the logic, then thereafter we'll straight away move to the numbers, right? What it says is approach note. Property, plant and equipment related deferred tax apply LKS 12 by identifying the temporary difference arising from the revaluation, impairment and difference between the accounting and the tax base that we already discussed. Distinguish between assets recovered through use versus sale and apply the appropriate tax rate. That also we discussed. Evaluate the applicability of the initial recognition exemption, which I will discuss. What do you mean by that once we move through the question? Applicability of initial recognition exemption, and ensure that deferred tax balances reflect the expected method of recovery. Deferred tax assets and the liability should be recognized for taxable or deductible temporary differences resulting from the property, plant and equipment balances as per para 15 and 24 of LKS 12. I told you don't need to remember the para numbers. Right. Now let's take one by one. Right. Let's take one by one. Okay. Okay. Let's take one by one. First of all, what happened was, if you go back, first of all, the first bullet point is about the revaluation. Now what will happen because of the revaluation, right? So the land value, what is the cost of the land? 1.2 billion, okay, or else 1,200 millions. So no accumulated depreciation, right? No accumulated depreciation, and also no capital allowances. Now once you do the revaluation, what will happen? Carrying value of the land has gone up by 10%. At the moment, what is the carrying value? As there's no accumulated depreciation, carrying value is 1.2 billion. 1.2 billion into 10%, right? 1.2 billion into 10%, how much? If I write down here, this one, no? This is with regard to land. 1.2 billion into 10%. That comes to 120 million. So carrying value of the land will go up by 120 million. Okay. What will happen to the tax base? Will the tax base changes? No. I told you revaluation, impairment won't change the tax base. Now, what happened is, earlier, before doing the revaluation, what was the carrying value? 1.2 billion. 1.2 billion is the carrying value. Listen carefully. Yeah? Then, what is the tax base? What is the tax base? With regard to the lands, okay, with regard to the lands, you are not given, right? You are not given. Now, 1 second. Here, whether the answer is there, then it's easy for me to explain. Okay, here its answer is there. So now, after making the adjustment, because cost was 1.2 billion, right? Cost was 1.2 billion. Then with the revaluation, so there's a revaluation gain of 120 million. So what's the double entry? Debit land and credit the other comprehensive income. Through that, it goes to an equity reserve or revaluation reserve. So with that, carrying value of the land increases. What is the carrying value of the land? 1,320 million. That is 1.2 billion plus 120 million. But is there any change in the tax base? No, no change in the tax base. Because why? I told you, the taxman or the inland revenue doesn't identify these adjustments like revaluation, impairment losses, nothing. So for them, it is the value or the cost minus the capital allowances. Now there are no capital allowances on the land. So because of that, tax base continue to be the 1.2 billion. That is cost minus no capital allowances claimed. So the tax base is 1.2 billion. Now, earlier with regard to the land, there was no difference between the carrying value and the tax base, because both carrying value, as there is no accumulated depreciation, both carrying value and the tax base was 1.2 billion. But now it creates a difference. No? Now the carrying value is 1,320 million, tax base is 1.2 billion. So that would lead to a temporary difference. I told you, if now these are assets, all these things are assets, if the carrying value is higher than the tax base, it is a what? Taxable temporary difference. So which means you have to pay more taxes in the future. So what is the taxable temporary difference? 120 million. That is the revaluation gain in simple language. Once you have a taxable temporary difference, what you do? You have to recognize the deferred tax liability. I told you, when you are recognizing the deferred tax liability, you have been given two tax rates. So depending on the way that the value is going to be recovered, the tax rate is different. If the value is going to be recovered through the ordinary course of business, 30%, through a sales transaction, 10%. So our assumption is, if the asset is a non-depreciable asset, you are going to recover the carrying value through a sales transaction. So which means I have to use the tax rate of what? 10%, not 30%. Right? Why 10% here? Why 10%? It's clearly mentioned over here. 10% for the profits generated from the sale of any property, 30% on profits generated from the ordinary course of business activities. Right. So then what is the deferred tax liability? 120 million into 10%, 12 million deferred tax liability. With regard to the land, only adjustment that we had to do was the revaluation. So because of the revaluation, because the revaluation gain, it creates a taxable temporary difference of 120 million. So we believe that as the land is non-depreciable, you are going to recover the value of the land by sales transaction. Then you have to take the tax rate of 10%, 120 million taxable temporary difference into the tax rate. You get the deferred tax liability, which is 12 million. Right, here. Then let's move to the next one. Right, 10% of the land. Right. Then what is the depreciation? What is the revaluation gain in terms of the building? 5%. Revaluation gain in terms of the building, 5%. Now, what is the current carrying value? So, how do we get the current carrying value? Cost is, now if you look at building, how do you get the current carrying value? Because revaluation gain is carrying value into 5%. So you take the cost, which is 1 billion, out of that you deduct accumulated depreciation. So 752.5 million. Right? So the revaluation gain is from the carrying value 5%. $37,625. 37,625 million. So this is the revaluation gain. So what will happen? The revaluation gain will increase the what? Carrying value. Now, earlier the carrying value was, before the revaluation, 752.5 million. So then there's a revaluation gain of 37,625,000. So the double entry is build in debit and credit to OCI. Through that it goes to a equity account called revaluation reserve. Now the new carrying value is the total of these two, existing carrying value plus the revaluation. So what is the new carrying value then? 790,125,000. That is what? The total of 752.5 million plus revaluation gain of 37,625,000. 790,125,000. So that is the carrying value of the building after the revaluation. What is the tax base? Tax base won't change because of the revaluation. Cost 1 billion, you have already claimed capital allowances of 500 million. So 1 billion minus 500 million, what is the tax base? Tax base is also 500 million. So the tax base means the amount of the asset what you can claim in the future tax returns, because out of 1 billion you have already claimed 500 million. So another 500 million can be claimed in future tax returns. So that is the tax base. So that is straightforward. Carrying value of the building is higher than the tax base by the difference between these two, 290,125,000. Then building is a depreciable asset. You are going to recover the value through use. So that means you have to use the tax rate applicable for the ordinary course of business, which is 30%. Yet again, this is a taxable temporary difference because the carrying value of the asset is higher than the tax base. So taxable temporary difference of 290,125,000 into 30%, you derive a deferred tax liability of again 87,037,500. Are we clear? That is with regard to the building. Right? That is with regard to the building. Then move into the next item, machinery. Machinery, there is no revaluation gain, am I correct? Sorry, over here, machinery, yeah, so the revaluation gain is relevant with the land, building and motor vehicles. But machinery, there is something else, impairment. So with regard to machinery, you have identified there's an impairment loss of how much? 20 million. So impairment loss would reduce the carrying value. Now what is the existing carrying value? If you look at the machinery, existing carrying value is 1.3 billion minus 645 million. Which is 655 million. So existing carrying value is 655 million, 1.3 billion minus 645 million. So this existing carrying value will be further reduced by another 20 million, right? So in terms of the machinery, if I write down here, current carrying value is 655 million, right? You recognize an impairment loss of 20 million. So which means carrying value after recognizing the impairment loss 635 million, right? So that is what you take as the carrying value here after the impairment loss. Tax base, straightforward. Cost minus capital allowances claimed. 1.3 billion minus 975 million. 325 million. Yet again, there's a temporary difference. Carrying value of the asset is higher than the tax base, so that temporary difference is a taxable temporary difference. So the difference between 635 million and 325 million, which is 310 million. And that is also a taxable temporary difference. This is a depreciable asset. Machinery is a depreciable asset. So that value is going to be recovered by using the asset in the business, so that the tax rate applicable for the ordinary course of business activity is 30%. 310 million into 30%. It's a taxable temporary difference again. You will derive a deferred tax liability of 93 million. So always remember, if it's an asset, carrying value is above the tax base means it is a taxable temporary difference leading to deferred tax liabilities. Right. Next, we are moving to the motor vehicles. Motor vehicles also, there's a revaluation gain, 4% over the carrying value. If you look at motor vehicles, what is the current carrying value? Cost is 900 million minus 89 million 100,000. So which means current carrying value would be how much? 810,900,000. Okay. Right. So what is the revaluation gain? 4% of the carrying value. As per the question here, 4% for the motor vehicle based on the carrying value, which is 32,436,000. Right. 32,436,000. That you add to the existing carrying value, because we calculated earlier existing carrying value is 810,900,000. To that you add the value of the motor vehicle because of the because of the revaluation. Because of the revaluation, there's a revaluation gain 32,436,000. Once you add up that to the existing carrying value, so the carrying value of the motor vehicles are 843,336,000, right? So how did you get that? Existing carrying value of the difference between the cost minus the accumulated depreciation, 810,900,000. To that you add the revaluation gain of 32,436,000. So then your new carrying value would be 843,336,000. Right? Then what is your tax base? If you look at the tax base, if you look at the tax base, it's mentioned here. This is something that you need to understand properly. This is where this initial recognition exemption would come into play. Now, before I get the tax base figure, think about at the time of acquiring these motor vehicles on the day one. Forget about the depreciation. This has happened subsequently. No? On the day that you acquire the motor vehicles, what is the carrying value and what is the tax base? Carrying value is how much? It has to be 900 million. The day one you bought it, it is there in the books at 900 million. Right? What is the tax base on day one? Tax base is what? 0. Because why? Tax base, I explained you, amount that can be claimed in the future tax returns. With regard to motor vehicles, it's clearly mentioned that you can't claim anything in the tax return. It is not allowed. So then if you can't claim anything in the tax return, what is the tax base? Tax base is 0. Now on day one, on initial recognition, carrying value is 900 million, tax base is 0. What you need to do? You recognize the deferred tax liabilities based on the temporary difference. Now there's a temporary difference, right? On the day one, because carrying value of 900 million, tax base of 0, so the taxable temporary difference is entire 900 million. On that, if you want to recognize the deferred taxes, 900 million into 30%. It's a depreciable asset, no? 30%. So which is how much? Straight away 270 million deferred tax liability. Are we doing that? Do we do that? No, because why? In deferred tax standard, there is an exemption of recognizing the deferred tax liabilities and the deferred tax asset on the temporary differences. There are few exemptions. Okay, there are very few exemptions. So yet again, I don't have time to explain all these things, right? Go and refer the tute, watch the videos if you can't remember. So one of the important exemption is initial recognition exemption. Now, on the initial recognition, so now this temporary difference of 900 million, what I have just explained, was created on the initial recognition of an asset. Right? So, what you can do is on the initial day, if it creates a temporary difference of such nature, what I have explained, that is exempted of recognizing the deferred tax liabilities and the deferred tax assets. If I show you quickly the place where this has been discussed, otherwise you will think that, okay, where is this from? Okay, I explain this. We go down. This is the theory tutorial over here. Look at this. Deferred tax should be provided for all taxable temporary differences unless deferred tax liability arises from, forget about the first point, you don't recognize the deferred tax liabilities on the goodwill in consolidation. That is also an exemption. What is important is the second bullet point. Unless deferred tax liability arises from the initial recognition of an item. Now think about this example, what I have given you. In this case, deferred tax liability of taxable temporary difference of 900 million, deferred tax liability of 30% out of that, 270 million. So that deferred tax liability arises on the what? Initial recognition of an item. Initial recognition of an item, in this case, initial recognition of the motor vehicle, item is the motor vehicle, that affects neither, no impact on accounting profit, no taxable profit. So initial recognition, does it have an impact on accounting profit? No. Because subsequently only it has an impact on the accounting profit. Then Does the initial recognition has an impact on the taxable profit? No, it can never be claimed for the tax purposes. So that means no impact on the taxable profit at all. Right? Then, and which does not result from a business combination. This is not a business combination, what I have spoken about. So, what is it? So, basically, you should be aware. If you buy a motor vehicle where you are not allowed to claim for the tax purpose, normally what will happen is administrative purpose motor vehicles. Let's say your CEO is using a motor vehicle, company-owned motor vehicle. So, that is for administrative purpose. So, those motor vehicles cannot be claimed for tax purpose. Then you should be aware on the initial recognition, there's a carrying value, no tax base. There's a taxable temporary difference. Normally, you need to recognize the deferred tax liability on that, but we don't recognize because why? You can claim the initial recognition exemption. Clear? So that means, are you going to recognize the deferred tax liability on that initial recognized temporary difference of 900 million? No. You claim the exemption. Are we clear? Very important, right? I discussed. With examples I discussed. So now you see, once you look at the pilot paper, when I was discussing the questions, I always refer to the theory tools. And you have witnessed now, there's nothing out of the tutorial. Nothing, absolutely nothing. If you know the theory, you can answer the question. Any question. So that's why I said that these tutorials are carefully prepared, right? By taking the essence of the standard. You should not try to make a summary out of my tutorial, right? Okay, because the main thing is the accounting standard book. I know that you are very busy and you don't have time to read those things. Even you are supposed to do so. So then accounting standard, out of that you have the study text. So that is the summary of the accounting standard, let's say. Then what I did, I have prepared a summary out of it, put in the essence of the standard, what you need to know in terms of the examination. So then out of that, if you are trying to prepare a summary, you are in a danger. Don't do it. So everything what is there in the slides, tutorials are really important. Now you witness them. There's nothing to exempt out of the tutorial. There's nothing to exclude out of the tutorial. Right, okay. That is clear. But the tricky point here is, thereafter, that is the initial recognition exemption. Thereafter, what they have done a re-evaluation of the motor vehicles. After some time, after few years, they have done a re-evaluation of motor vehicles. Then that re-evaluation results a re-evaluation gain. Okay, it results a re-evaluation gain of how much? It results a re-evaluation gain of 32,436,000. Now, yet again, this creates a what? Temporary difference, isn't it? Because why? Revaluation is recognized in the accounting. So your carrying value increased. So basically what I did was, so this carrying value, what it was there before the revaluation, I have added that amount, the revaluation amount to that particular carrying value. So the carrying value increases because of this revaluation gain. Okay. Carrying value increases because of the revaluation gain. But is there any impact on the tax base because of the revaluation gain? No, because I told you taxman doesn't understand the revaluation impairment, not in his books, not in his terminology. So tax base won't change. Carrying value increased by 32.4 million. Tax base won't change. That again amount into a taxable temporary difference of 32.4 million. My question to you is now what again? Are you going to recognize the deferred tax liability on that temporary difference, 32,436,000? Yet again, it is relevant with the motor vehicles. Are you going to recognize the deferred tax liability on that? Can we claim the exemption what we just discussed? Initial recognition exemption. No, right? Because why? This is not the initial recognition. Initial recognition means day one recognition. This is what? Subsequently. After some time, you have done a revaluation so that the carrying value has gone up by this amount. Tax base won't change. It creates a taxable temporary difference. On this difference, you have recognized the deferred tax liability. That is the tricky point. So basically, what will happen is, with regard to the motor vehicle, I'll start from here, your temporary difference is limited to the revaluation gain, because whatever happened at the initial recognition is exempted. But the revaluation is not the initial recognition, that amount into the taxable temporary differences. So the value of taxable temporary difference is equal to the what? Revaluation gain, 32,436,000. Which means there should be a difference between the accounting and the tax base by this amount. Okay, so then your tax base has to be the difference between 843,336,000 and 32,436,000. So what is the balancing figure? This minus this, 810,900,000. That is actually the what? Carrying value before the revaluation. Okay, even when you are doing this question, I don't mind you. So this is the way that it has been worked in the suggested solution. But when you are working the question, I don't mind you actually ignore these two. You don't need to put these two lines. You just take that revaluation has created a taxable temporary difference of 32,436,000, because everything else is what? Exempted. Right? That into 30%. Again 30%. Why? Motor vehicle is a depreciable asset. So then you are going to recover the value through use, ordinary course of business. That into 30%, you will be getting a deferred tax liability of 9 million. How much is the deferred tax liability? 9,730,800. Okay, if you want, you can keep these, right? There's no issue, whatever the way. If you want, just put this and take the deferred tax liability, or else in the manner what I have explained, even you can take the numbers. Nothing wrong, right, doing that. And you can keep it, no issue. But the important aspect is this, and the logic what I have explained. Okay, right, clear. So that's why, like, if you look at LMS, there are a lot of past paper questions have been uploaded into the LMS, right? Even the last 5 to 6 past paper questions have been uploaded. Why I have uploaded is similar type of questions have been tested there. If you look at December 2023 paper, there's a deferred tax question. That question is actually a bit complicated than this as well. So there even you have been given 2 tax rates like this. So I explain how to do that, how to do the computation in that particular question as well. So if you have not gone through, look at that question. That is also a good question, right? Even though their syllabus change, it is ultimately what is getting tested is the what? Accounting standards. Okay, right, fine. Moving on. Right, so we have done up to the motor vehicles. Now I am moving to the other equipment. That is straightforward, no adjustments, nothing. You just take the difference between the carrying value and the tax base. What is the carrying value? 800,000 minus accumulated depreciation 75,800, which is how much? 700. Sorry. What is this again? If I explain you, cost is 800,000, accumulated depreciation is 75,800. So the carrying value is 800,000 minus 75,800, which is 724,200. Then the tax base, cost minus the accumulated depreciation, 800,000 minus 160,000, which is 640,000. So again, carrying value is higher than the tax base. What is the difference between the carrying value and the tax base? 84,200, right? Depreciable asset, value would be recovered through the ordinary course of business, tax rate of 30%, taxable temporary difference of 84,200 into 30%, deferred tax liability of 25,260, right? Finally, capital work in progress. What is the carrying value? No depreciation yet, because depreciation starts once the asset is ready for the intended use. It is not yet ready for the intended use. So that 750 million minus 0. So the carrying value is 700 and carrying value is how much? 750 million. No depreciation is yet claimed. But for the tax purpose, what has happened is, according to the question, for tax purpose, over here it's mentioned, capital work in progress was allowed for the tax computation in the respective years in which cost was incurred. At the time of incurring the cost, it has been already claimed for the tax purpose. Entire 750 million is claimed. So the cost is 750 million minus 750 million. As the entire thing is claimed, what is the tax base? 0. There's nothing to be claimed in the future tax returns. So this is 0. So 750 million is the carrying value, tax base is 0. It creates what? Taxable temporary difference of 750 million, because again the carrying value of the asset is higher than the tax base. So the capital work in progress, even though it is not getting depreciated now, it is a depreciable asset. In future it will be depreciated. So it's a depreciable asset. So that tax rate applicable for the ordinary course of business of 30% to be used. 750 million into 30%, deferred tax liability of 225 million. Right, that's it. So you can go through the answer explanations. There are some more explanations you can go, because I have explained more than what is there in the suggested solution, and I explained the computations. So if you know the theory, simple question. If you don't know theory, you can't answer. So the examination is not difficult right now. If you can't answer this question, it's actually the lack of, I would say, the knowledge, because all these things have been covered in the theory session, right? Because we have done complicated questions than this. Even in the LMS, as I mentioned, what I can remember is this particular past paper question, what I just explained, December 2023. So that question is much more complicated than this. Right, okay, so we have now answered to part B of the question, part B of the question. Then part C of the question is with regard to the part C of the question is with regard to the digital, right, cloud-based platforms. That particular section will be covered by the lecturer who is doing the digital part. So in this syllabus, actually the predominant area is financial reporting. In addition to that, there are areas from digital and sustainability. So we actually have two experts who are doing that. So they have covered the theory. So the relevant questions in the pilot paper would also be done by them. So this is with regard to digital, so that I'm not going to do this particular part. Right, so with that, that means we have completed now the second question of the pilot paper, which is actually part of section B. Section B, you have 3 questions. Out of that, you need to answer 2 questions in the examination. Now, out of those, now the first question I have covered. In the paper, it is the second question, but in section B, this is the first question. Right, okay.